topic is basically everything you needed to know about tax other than income tax. So it's all of the other areas where the government, both state governments, local governments, and federal government, all of the stuff that is involving tax that isn't to do with income tax. Whereas 95% of the subject is income tax, but this particular topic is stuff that doesn't, things that are exempt from income tax or things that don't certainly relate to it. And so there's a lot of information. Some of it's going to be pretty intuitive though, and it'll just click based on your own experience of things. Some of it might not. Non-income taxation. Look, as you're aware, I teach the advanced tax subject here as well, and we have a topic which we talk about as indirect taxation. We do have one of the subjects where we do that. Indirect taxation is basically things that aren't going straight to property or to particular phenomenon, land or income. Those are indirect. So direct taxes go directly to a particular thing, a phenomenon, whereas indirect taxes is basically everything else. And so for those that do want to go on and do LA4023 or BX3113, which is the two codes for the advanced tax subject, we go over indirect taxes again, still doing it in one lecture, but it's noticeably more depth. So you're sort of getting about 50% more depth on each of those topics. It's also quite helpful as a refresher for those that are going out into practice. And advanced tax is taught in trimester 3 only. And so people are often there either already working or about to start working. And so that going over particularly FBT and GST again is pretty helpful. So other than income tax, we have the goods and services tax, the GST. We have tax to things that employers pay to employees not in cash, which is taxed through a system known as a Fringe Benefit Tax or FBT. Royalties actually don't cover royalties for this. Maybe I should put a slide in for royalties, but royalties, they're their own phenomenon. They're ordinary income as part of that, and it's the exploitation of resources. So that because of the way royalties are set up, it's kind of like if you own something and you're renting it out or leasing it out and getting paid to go through and do that. So when we talk about that as being a tax, I mean, it kind of is, in that certain phenomenon are owned exclusively by the Crown, like the royal metals, and we put it under the same heading because it's involuntary, but ultimately it's really covered more under the income topic instead of this one here. Then we've got excise and customs. These are two sides of the same coin. Oh yeah, tick, get a tick for that. And excise and customs are excises on particular types of goods inside Australia, and customs are pretty much the same stuff, but it's on things that are being imported. And there's a variety of other things imported from particular countries where there are tariffs as well. That's what customs is about. Stamp duty. These, by the way, are all GST, FBT, excise and customs. These are all federal taxes. So they're still done by the Commonwealth. Royalties is both Commonwealth and state governments. They both do this. Whereas stamp duty, payroll tax and land tax, these are state taxes. And I exclusively talk about the state of Queensland. We're not worried about other states. Yes, some of the things are going to be the same or similar, but often the rates are different. So that can be a little bit annoying. And local government rates are functionally a state tax as well, because the local government bodies are created and given statutory power by essentially the Queensland Parliament. Then you have a variety of other taxes to do with particular financial structures or arrangements, particular industries, and sometimes actual particular organizations. And so you've got particular industries or phenomenon, things like gambling, insurance, but also you can have taxes for particular entities like casinos, particular casinos, or particular often large entities, the banks, insurance companies. There have been from time to time particular like mining rent tax, where they've taxed a particular industry in a certain way. Those things, they're very narrow in application and structure, so we don't go over those here. But the one with big area, huge area of contemporary tax practice is this one, superannuation. So that we will talk about that in a bit more depth. We will kick off with the first of these, which is the GST. Look, GST is actually real simple. It's a simple phenomenon. Once you've got your head around how it works functionally, everything else is easy. And there's a couple of pieces of technical language that once you know this technical language, it is also easy as well. I swear, and there's not that many phrases, but we will need to clearly and carefully identify those phrases, because very annoyingly, there is one phrase in terms of GST which is used in two different ways, and it's not even a real phrase. It's this thing here, this phrase input tax, right? It's just a stupid phrase. Think of that as its own technical term. It's used in two quite different ways, which I'll talk about. Very, very annoying. So provided you know in advance that this is dumb, I'm hoping you'll just be able to overcome that, tuck away a little piece of information, and basically know how GST works. So first thing about GST, GST is not technically a consumption tax. It's technically a tax on the supply of goods, okay? And so that's the first piece of information you need to know. And the thing is with GST is that when you are supplying goods, you have to collect a fraction of the money that you get, give it to the tax office. That's 1/11th of the listed amount. So if you, if Stacey, if I'm selling you, let's say I'm a manufacturer of ceramics, right? I manufacture cups. If I'm selling to you, and I create a bunch of cups and I sell them to you for $11,000. Okay. All right. So you're paying me $11,000. I'm giving you goods worth $11,000. Great. So we've got that first step. In fact, I might even draw this out. So this is me, SW, to, yep, exactly. Thanks, Akil. Yep. And so here's to Stacey Rogers. All right. And I'll pick on Claire. Let's say that Claire is the consumer, the ultimate, or the retailer. So I'm the manufacturer. Stacey's the wholesaler. Claire is the retailer. So let's say I'm sending them this way. Oh, might use a better color. Going there, and I'm selling it for 11K. That's the listed price. Of that, $1,000 or 1K is going to the ATO. Blue. Is the okay? We'll get there. We'll get there. What happens is, then you appreciate from Stacey's perspective, she's paid $11,000. But let's just say she sells them off to Claire, and she sells them for twice as much. There we go. So you can sell them for 22K. All right. So Claire is going to pay you, pay Stacey, in terms of cash, $22,000. Okay. Of that, $2,000, 1/11th, is going to go off to the tax office. Okay. That's the straightforward or easy part. However, there is another side to this. That is when you are spending money to get things that you are then sell, so they're called creditable acquisitions, you have to pay amounts that have GST as part of it. So here, for example, this amount of $2,000, because this is from Claire paying Stacey, this ends up in Stacey's bank account. She's actually the entity that has to post the thing off. With this amount of money, this is Stacey paying me, this ends up in my bank account, and I'm the one that has to send that off to the tax office. So appreciate that entity which is paying the money is not the one that's sending the thing off to the tax office. When you pay the money, you pay it to the person who sold the thing. They're the ones that have to sort out sending it off to the tax office. Well, that's just it. So when Stacey pays me $11,000. All right, we're trying to think about where is the money. The money is now in my bank account, and at the end of each month or quarter or sometimes year, I'm going to send them $1,000 as part of that. And similarly, when assuming that Stacey on sells the things in the same a week later or what have you, this $2,000, she's going to have to send it off. But, and this is the important thing to note, when you are spending money, the amount of GST that you spend on those purchases is a tax credit. So what does that mean? It means that this amount that Stacey has paid me, so she's paid me this $11,000, and I have to send $1,000 to the ATO, right? But she gets a $1,000 tax credit. Okay, that's an important point. Why? Because she's spent money to go through, and so that money's going away from her as part of having what's called creditable acquisitions. So 1/11 of the amount that she spent, she gets as a credit. What does that mean? Well, it means that in between her collecting this $2,000 and having to send it to the tax office, but getting a $1,000 credit, it's only the difference between those two things that she ends up having to go through and pay the tax office in regards to that. So the key thing to note about GST is that when you've got business to business transactions, right, functionally, one person's paying money to another and the other one is receiving cash. Now, the amount that I'm going to have to go and send off the tax office is equal to the amount of tax credit that Stacey's going to get. So functionally, all of these chains are tax neutral, so to speak, in terms of the commissioner's perspective. It's actually really only the end when Claire goes, for example, and let's say that she sells it to the public for, let's make it nice and easy, $44,000. All right. So then she's going to have to send 4,000 of that off to the ATO, but it's less the credit that she's got, which is going to be of $2,000 because that's what she's had to spend to buy things from Stacey in the first place.
Simon, so just really quickly,
yeah,
I'm behind. So anyone who's watching this recording or anyone who's in the session right now, and if this is a question that has already been answered in earlier lectures, please just ignore me. But sure. What's the difference between a deduction and a credit, though?
For the purposes of GST, we don't use the concept of deductions.
It's just
for the purposes of income. Yes, I can explain that. So
no,
a deduction is
it's not just that. It's like they were talking about the federal budget, whatever, how we're supposed to be getting that credit back, and that was like the first time I've ever heard like the term credit used rather than like deduction.
Okay, so what they're meaning there is a tax offset. Okay, so that look, and really annoyingly, and I know that you're behind. So when you go back and you're looking at, I think it might be actually be week 1 actually. Talk about the fact that in the legislation, the technical word that they use is an offset. However, the word credit is the casual word, and it's the industry word, and it's the lay person's word. For example, you may have heard of these franking credits. Last time we had an election, it was big. Franking credits is the idea that if you own a company and it pays you a distribution of, say, I don't know, $10,000, you get $10,000 worth of dividends. They will send you a check for $7,000 and give you a $3,000 tax credit. Now, technically, when you put that in your tax return, all right, the words that they use is an offset. But confusingly, to make it confusing, the lay the word that people on the street use is a tax credit. It's an American English thing more than anything else. The idea is that credits or offsets, which is functionally the same thing, are used to reduce the amount of tax payable. That's really what where these things are. So when we're looking at GST, and I talk about, with actually the technical phrase they use, and this is going to be really, really annoying, is input tax credits. That's the technical phrase they use to describe the amount of money you're going to get back from the commissioner when you've spent money. So if you, with your little ceramic wholesaling business, are going and buying $11,000 worth of ceramic stuff, you have to pay cash $11,000. But if you don't sell those in that month, you can ask the commissioner to just give you that $1,000 back. That's what they call an input tax credit as part of that. And it's annoying because they've used the word credit in this part of the tax law, whereas in the technical word that you use in regards to income tax, they generally use the word offset. That's just how and where that is. Does that kind of help?
Yep. So like credits, and that is more like takes it off your income, so to speak, or like the amount of tax you pay, and then deductions are like
no, stop. Let's unwind that. We're going to unwind it. So if you have an amount that you earn, which is a taxable income, all right, then you have that reduced by allowable deductions. And that, sorry, your assessable income is the amount before deductions. Taxable income is after deductions. Then you put that on the tax scale to work out the amount of tax you have to pay. This is for income tax. Then you go and apply the various credits or offsets. Again, they've used the word credit. They try to use the word offset throughout, but there are places just where it's just not. They've just used the word credits to describe it. Often, but not always, they use the phrase credit where you have a potentially refundable amount, whereas most tax offsets are not refundable. So, for example, living in Townsville or Cairns, you get an offset of $57. Why? Because that's just what it says somewhere in the old Tax Act. You can't, however, if you earn less than $18,200, you can't ask the tax office to pay you that $57. It's gone. It only goes against amount of tax that you would otherwise pay. Whereas if you, for example, have money deducted by your employer for PAYG throughout the year, that amount of money, if you reach the end of the year and they've deducted more than the amount of tax you owe, which they often do, you get a refund. Why? Because those amounts, which unlike offsets, they're refundable. And the same with franking credits, well, at the last election. That's how and where that is. And so input tax credits are refundable. So that makes them a bit different from sort of offsets.
Yeah, got it now. Apologies to all the accounting students.
Yes.
Big brain doesn't
awesome.
do maths. And also I just came from an equity and trust law lecture, so I'm already tired. Brain empty.
Love it. Equity and trust. Equity and trust. What? Together?
Wait, not equity and trust. Oh my God. It's ethics and trust accounting. See? E and T, and that's all I heard. Please
love
don't
it.
listen to this recording.
Just love it. You're doing well. You're doing well. So a couple of other things to note that this GST, there's a couple of, these are sort of fundamental points. One is that if you're advertising other than strictly to other businesses, so if you only sell to other businesses and those other businesses are aware that you're only selling those things, then you can list an amount, but you have to also say somewhere later on that then you've got to add GST on, right? But most situations, if there is at least one member of the public, you must, when you advertise prices, advertise the price inclusive of GST. And I've never been to North America. Claire, have you traveled much? And Akil, I don't know if you guys been to Canada or to the United States, not the US. Yeah, I've heard that it's terrible in that you end up with, you look at an amount. Oh, Stacey's traveled. Okay, good. Yeah, Stacey, that one there. So did you find this phenomenon where there are listed prices and then you get your bill and you're like, what?
Yeah,
What?
only when I was about 12. But I remember like because we went to Walmart and stuff, and we were really excited. We was like grabbing things because it's like feels so cheap. But then Mum had to keep reminding us that you have to then add the tax on top of everything.
Yeah.
So we would literally be sitting there like with our phones out, calculators,
Oh,
like
wow.
adding the tax onto stuff because we're just so used to it. And I actually was talking
Sure.
to one of my co-workers who is American, and he said like that's why he thought he came over here, and he had to stop his brain from doing that automatic like math on things, and he thinks it's a much better system that we already
Oh, of
automatically
course.
add it.
Oh, absolutely. With it, there's you know, it's if there's an argument for against libertarian thought, the Americans, you know, the society is far more libertarian. You know, it's, you know, harden up, do this, that, and the other thing. And Asian countries as well find that too, where you're having to have your brain on all the time to just functionally do things. Akil, I don't know if you find this too. When you're walking down the street, having to consciously be aware of traffic, motorbikes, and other bits and pieces, and potholes and other things, you have to have your brain switched on all the time. And here in a heavily regulated society, when I walk down Riverside Boulevard, I don't have to think, and it's huge. It's actually huge. This cognitive overload that we have in terms of not having to think about stuff is huge. It's a really important phenomenon, and there's a lot of literature on it these days with the psychologists. And sure, yeah, we're taxed, but ultimately, in Australia, we've come to accept the amount of government benefits and services and having a well-organized and structured society. Yeah, it's we're taxed quite heavily, and other people are, you know, horrified to go through and do that. And I'm always really angry when people start to try and put taxation into political arguments or debates, because this we, you know, we have good lives. And again, I'm not sure. Claire, you're Australian, or Akil, you're not. And Rizvi, I'm not sure whether you're around, but it's coming into this country, and I'm coming from quite a similar country. It's you know, you notice it. You notice this country just feels wealthier when you go and you look around at the parks. Like I said, I go down. I live in Douglas. I just wander down Riverside Boulevard, and it's beautiful. It's just a beautiful place to live, and it's all done. You know, the council goes and does this, that, and the other thing, and I don't have to think about stuff. I don't have to think about the water. You don't have to think about a variety of things. You know, if you get hit by a bus, you don't have to think about whether you can pay the ambulance, and all of this sort of phenomenon as part of it. Anyway, so that's why we have to learn tax law. Why? Because ultimately, this is for the benefit of creating a good society. It's for a better world. Okay. Anyway, so that's that one. The other thing is, of course, 1/11th. The reason why I'm using these numbers, $11,000 and $22,000 and $44,000, is that it divides very evenly. So that if you get an invoice and it is inclusive of GST, you have to multiply it by 1, and then, well, don't multiply by 1, divide it by 11 to work out what the price is. What the GST credit is, and or multiply by 10 and divide by 11 to find out the GST exclusive amount. Okay, next. Oh, there's a couple of words, by the way, we have to talk about, these words here. So in order for something to be taxable, it's got to be a supply. That's the key operative phrase. It has to be for consideration. It has to be in the course of or furtherance of an enterprise connected with Australia and made by a GST registered entity. And there's also these two phrases here. This is where things are going to get really, 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 really annoying. Okay, these two phrases, GST free and input taxed. Because you'll notice, but in the previous slide, we had this concept of input tax credits. Okay, then we're talking about supplies that are GST free or input taxed. And do you know the most incredibly annoying thing? It means something completely different. They've used the same word to describe two completely different phenomena. I don't know why. I think whoever came up with this idea is an idiot, but we're stuck with what we're stuck with. So students of tax law, you're going to look at this and go, why? Why is this called this? They could have called it anything else. They could have said you have GST supplies and you have nil rated supplies, which is what the equivalent phrase is in New Zealand. No, they called them input taxed. Why? No idea. No idea. Just anyway. So a couple of things to note here. Each of those phrases, and this has been done by the courts, they've looked at these and they've given them very, very wide interpretation. So if you are looking at something, you're trying to determine whether it's a supply, whether there's consideration, whether it's the course of whether it's an enterprise or connected to Australia, if in doubt, it almost certainly will count as being something subject to GST. That is by design. The legislation is expressed very broadly, and the courts have taken that and run with it. A couple of things aren't supplies. All right. Digital currencies, Bitcoin, not GST. It's not GST. It's not that it's zero rated or it's input tax and stuff. It's just that they're not subject to GST. So if you're buying currency, buying and selling foreign currency, right, they're not GST transactions. They're just not. Same with paying or loaning money, and the same with having options to go through and buy and sell money. But options to buy and sell goods in the future is something that is subject to GST. Okay, so just make note. So things that are purely involving money, both Australian dollars, foreign dollars, and also digital currency, and not GST in regards to those things. The airlines got into trouble, Qantas, good old Qantas. If you prepay for something, so if I prepay for airlines stuff and then I don't turn up, even though they didn't perform, it still counts as a supply for the purposes of the GST. Okay, note that if you supply goods, but you do it without being paid, so either no consideration or for an inadequate consideration, it's to an associate. This is an exhaustive list. In other words, it doesn't say anything like have an open-ended class at the end of it. It's just if you are blood relative and it's limited. I actually don't think cousins count. I think it's only one step. So aunts and uncles count and nieces and nephews count, but cousins don't. But it does count people who are adopted and or step relatives as well. Also counts trustees and beneficiaries in regards to the same trust, and companies and directors in regards to whether or not the particular person supplying is either influenced or influencing the particular company itself, or control it. Controlling, that's an interest of 50% or more. Okay, so that's just make note. So that they will put in, basically it's like the market value substitution rule for CGT. If the thing is sold for less than what an arm's length value would be, and you're an associate, the amount of GST that you got to pay is deemed to be the market value. There's lots of little pieces of trivia. You're like, oh, okay, sure, that makes sense. Sure, that makes sense. And with GST, it really does. There's not a lot of unintuitive things other than the names. Course of an enterprise, it's more than merely businesses. It includes joint ventures, leases, licenses, and grants and property. That's a pretty broad one. That idea that if you are a lessee or you're going through in the process of leasing stuff, that things in regards to that, even though you haven't got a business, you might have your rental property, that's still in the course of an enterprise. So it's much broader than merely a business. It includes super funds as well, or the trustees thereof, but also charities and government bodies too. They're all deemed to be in the course of an enterprise for the purposes of GST. Commonwealth and state and local government bodies are all have to pay GST when they have transactions. Those are supplies that have GST associated with it, but it does exclude employees. When you are doing things to and from employees, you are not doing things, and there's no concept of GST in regards to those two things. You're not supplying goods for the purposes of the GST legislation. Same with hobbies and private recreational pursuits, and also individuals and or groups of individuals that have, even in situations where you've got an unincorporated association or or incorporated association where there is no expectation of profit or gain. by default, that's not going to be in enterprise. So they've just taken the ordinary meaning and they've just run with it. And same with connection to Australia. Oh, I didn't fix this up. It's for real property in Australia. Bugger. Sorry about that. Oh, me on recording. Sorry about that. I saw that in class and I meant to fix it, and I fixed the other ones and I didn't fix that one. So note that it's really broad. I mean, the recipient's an Australian consumer, and that's Australian as in domicile, so citizen or permanent resident. It's a right or option to do something connected to Australia. Surprise. Oh yeah, that's thanks. Probably Stacey, but maybe Jen. Not sure or Claire. Super broad as part of these. Really broad, and like it's by design. They want these things to capture those situations. Okay. Registration. Right. Now, you have to, now when I said before about if you're selling goods for $11,000, if you're not GST registered, you get to keep all the money. It sounds great. Well, that's good and all, but the turnover amount is $75,000. If you are registered or are required to be registered, then you are required to remit that GST to the commissioner. And if you choose not to register, then or you can't charge GST in regards to that. So it's you have to. Oh, there we go. I'm just going to fix this one here. That's just really annoying me. I'll have to fix it now. You have to do a BAS return. Do you guys pronounce it BAS or base? Because Elliot in class reckons that it's BAS. I don't know. Claire, do you have to do these things? I'm not too sure, or Jen, or Risby. Risby, I'm not sure if you're working doing accounting these days.
I would have said BAS, I imagine.
BAS, yeah, I thought it was BAS, but I can't remember. When I was first exposed to these, I was a software developer.
Actually, you know what? I have heard my mum say back in the day, BAS.
Yeah, Risby?
I guess it's base.
Base. Okay. Is that the professions? Yeah, I thought it was base when I first was exposed to this. It sounds cooler. But ultimately, I think we all know what we're referring to. Those forms that you have to do every month. And look, I gather that most of these, if you're using MYOB or Xero, the software will go through and generate these things and probably transmit them off. I actually said I had a job. This is 20 years ago, doing the for MYOB, actually building or software generating BAS or BAS statements with GST in them that had to go off as part of the cash flow cashbook app that we had. And look, there's not a lot to it. You've just got to fill in the thing that has all these different activity metrics. And if you're when you're doing that, it just as part of that, it works out the amount of GST that you have to pay. Or if you have spent more on credible acquisitions, the amount of GST you're going to get back. That's one thing. So note that $75,000, if that's your turnover, you must be registered for GST. Some industries like taxis have to be GST registered, and Uber drivers as well. Okay, right. So if you pay money, you're earning credits. If you are selling stuff and being given money, you are having to keep that and pay that amount of GST collected to the ATO. But it's the difference between those two things. So if in a particular period you have spent more money, you've gained more input tax credits, but usually by spending more money than what you've received in terms of sales, in terms of the money collected, then you'll get a refund from the ATO. That's how that works. Now, this is just restating what I've mentioned earlier. It's 1/11 of the price. So when you buy something, the phrase they use is a creditable acquisition. That's the technical phrase. And you get an input tax credit. In other words, the amount of tax you're having to spend money, but the ATO is going to owe you that exact amount of money when you fill in your BAS or base or BAS return at the end of each month or quarter, or sometimes annually if you've got a low turnover. And yeah, that's how and where that sits. So that's it. So that amount of money that you're spending is going to be refundable in whole. Don't get me wrong, every accounting student knows that a dollar in your bank account now is worth more than a dollar that you're getting at the end of the reporting period. But functionally, it's not a big weight in regards to these things. And note that said, because of the fact that one party is required to, when you're selling stuff and you get the money, you're required to pay that to the commissioner. But the person that you are, the person who's done the buying and had to do the paying, they're going to get a credit of the exact same amount. So between two businesses, neutral to GST in regards to that. It's only the end where it matters. Now, unlike other areas, income tax, for example, it's quite common at the end of each reporting period for something to have gone wrong. So GST is an area where you do a relatively large number of adjustments. For example, if your stock gets destroyed. So if your stock gets destroyed, or you've, for whatever reason, or you've had to send it back, there's some other mechanism whereby your particular supply is no longer taxable. So, for example, you've bought something, and then the transaction's been reversed, or some fraction of it has gone back, or it's been destroyed, whatever. You can have what's called an adjustment event, and you put that in your BAS statement, and it's going to either increase or decrease the amount you'd otherwise be paying in terms of GST. And so the reason we mention this here is that it's far more common for GST items than it is for things like income tax. So income tax you can do, it's a change of assessment to after the fact and go back and redo things. You can do that. It's quite a rigmarole. Whereas with adjustment events, because it happens all the time, usually you do actually do it literally in the same return. And then if the thing becomes creditable, the adjustment happens at a later stage. In that next return, you then go through and do an adjustment event. That's just it's a bookkeeping exercise. All right. Once you've collected GST, you've got to pay it. And GST is usually quarterly. You can register for GST even if you've only got turnover less than 75,000, and taxi drivers must. But if you have an enterprise and your turnover is less than 75, you can actually just do them annually, which is easier. However, if you have turnover of more than $10 million in a year, you have to do monthly. So the vast majority of taxpayers are between those two extremes and do them quarterly. Okay, this is where things start getting really annoying. GST free supplies, this is the good one, and input tax supplies is the bad one. That's the key thing to remember. Do you want a shortcut to this? GST free, good. Input tax, bad. Well, it's not so much that it's strictly speaking bad, because basically when you are purchasing supplies or you are selling supplies that are either GST free or input tax, they don't have GST in them. There's basically they've got a rate of 0 associated with them. Okay, so Australia, and this is where I'm going to, I said Resvi and Akil probably don't care, but I'm going to just basically slag off the Australian GST system here. Why? Because for political reasons, when getting these things through, the federal government at the time, which was the Howard government, had to make a bunch of concessions to a bunch of people, and so that there are a wide variety of goods and services that are GST free. What does that mean? It means that you don't pay GST on them. So if you're going to buy something, and here's an example, buying fruit. Fruit doesn't have GST on it. However, the person who's making the fruit, so the farmer or the people having the orchards, they can still claim credits on amounts that they spend creating the GST-free supply. If that makes sense? Does that make sense? So what else? Doctors have GST-free supplies, medical supplies, GST-free. But when the doctor purchases a chair for her medical facility, that's got GST associated on it, and you can get a credit, even though you're using that as a creditable acquisition towards making GST-free supplies. Whereas with input taxed supplies, and I'll go through what these ones are, if you are paying money or receiving money, there's no GST on it. So even if you are receiving money because you've made some sales that are input taxed, you will not be able to claim GST credits for acquisitions that you've made towards generating those input tax sales. So that's why it's the bad one, so to speak. Now, let's go through some examples. Here's some I prepared earlier. Food. They made it really complicated. Really, really complicated. I'm not going to go over it now, but there's a video, if you can look it up in your own time, by a politician, by a guy by the name of John Hewson. Google the birthday cake interview. Oops, I'm not going to spell the word interview right, but go and have a little look at that in your own time. That's a minute or so, where he tries to explain, before they had the GST, how GST was going to operate. And it is the biggest train wreck. It's about 90 seconds long, and it's an utter train wreck. Could I explain that again by chance? Okay. How about, I could, no, we probably won't watch it now. But if you go back and Google this, watch this on YouTube, a guy called John Hewson, birthday cake interview, where he tries to explain how GST works. Why? Because some foods are going to have GST and some are not going to have GST. It's just a mess. The whole thing was just a mess. So when they put it in, it became a little bit easier as part of that, but still it's messy. So when you go to the supermarket and you're buying goods, some goods you buy are going to be GST free and some of them are not. And so the definition of food for the purposes of GST is mapped out in the statute, and these areas are specifically excluded. So prepared food, confectionery, snacks, biscuits, bakery products, ice cream have GST on them. Okay, so they are not GST free. There are also other items that the ATO has included in this list as well. So they can do that by regulation. They don't need to ask Parliament to do that. So that if you're buying ice cream, it will have GST on it. Whereas if you were buying fresh fruit and veggies, buying mushrooms, buying bread, actually bakery products, not even too sure. Look, and this is where things just get messy. I don't know if you buy a loaf of bread as opposed to a artisan bread. No idea. That's why there's just a mess. They should never have done it. But they did. Okay, so that's food. Food that's other than ones on that list. Health supplies. This is a little bit interesting. Obviously, if you go to your doctor, medical services by GPs are going to be GST free, right? But they've been very, very generous in allowing a lot of allied health services, so psychologists and pharmacists and so on. Those are GST free also, even those that are a little pseudo-scientific, so herbal medicines, osteopaths, and so that, and look, I believe acupuncturists and alternative medicine are also fall under this umbrella. Basically, the tax office is not in a position to determine what's medical and what's not. So they've just given it broad definition. Note that if you go to the chemist and you buy stuff over the counter, that will have GST on it. Okay, whereas if you get a subscription, it will be GST free. So it won't have GST. So I know it sounds a little bit weird, but if you literally go into the pharmacist, get a script filled, that won't have GST on it. Whereas if you buy, I don't know, quickies or something, and then you take that to the counter, that will have GST on it. Okay. Again, for policy reasons, all hospital treatment other than elective cosmetic surgery is GST free. Again, they've got policy reasons in this, but ultimately it's pretty stupid. And the reason for that is, sure, I can see where you're going. Yes, philosophically, we don't want to have GST tax on food, but in practical terms, the GST rate's only 10%, and you've got a duopoly on supermarkets. So it ends up being a little bit silly. Cosmetic surgery, again, is another one as well. Well, you could make an argument. Me, for example, my nose isn't straight, so that I can't breathe properly, and I have difficulty sleeping. So the fact that that has GST on it, as opposed to if someone punched me and I had to go and have a cosmetic surgery, it's just silly. Anyhow, private health insurance is GST free also. Education. Ever had any thoughts about that, whether you have to pay GST on your uni fees? Well, the answer is no. Do you have to pay GST on your textbooks? The answer is yes. Although curiously, I actually don't know whether the student union actually charges GST or not. I suspect that they don't. I'm not sure. But if you're buying things in regards to your studies, you're going to have to pay GST on that. If you are, and this is where things get a little tricky, if you're purchasing things that are going to be necessarily consumed or transformed, so if you are doing chemistry, for example, and you have to buy hydrochloric acid for using in your experiments, then that is actually GST free. Although usually things like that are supplied by the institution, and they can charge you as part of that process. That's conventionally how they do that. Okay. This is a big one. This is one where strategically, this is probably the most important. And that is that when you export something, assuming that you export it within 60 days of being paid or issuing the invoice, that particular supply is GST free. Okay, what does that mean? Well, it's not input taxed, which means that you can actually claim back all of the input tax credits for everything you've spent in creating that export, which is awesome. I've used this example. My mother, and it's in Auckland, so it's the New Zealand GST system, but it's fundamentally similar to this in regards to this area. She does pet transport, which is an export business, and one of the things that her and my father just loves, is the accountant, loves going through and doing, is the GST return. Why? Because every month they get money back from the tax office over there, from the IOD. Because if you're an exporter, you still have to spend a whole bunch of money on stuff internally in Australia in order to create the thing you're exporting. And the things that you spend money on, you get the GST of that you get back from the tax office. It's a lovely, lovely time. So there you go. That's an important thing to note, by the way, in regards to people who are setting up businesses, and if you're advising them in regards to exports. Okay. Look, there's a couple of particular exemptions we have. They changed this rule a couple of years ago with $1,000. So it used to be that online purchases didn't have GST on them, and Jerry Harvey whinged and moaned about that and managed to lobby the federal government to change that. And so now that GST is charged, so when you purchase something online from overseas, you have to pay GST on it. If it is for more than $1,000, you have to organize the GST yourself. If it is for less than $1,000, then the vendor has to organize the GST. It just occurred to me. I've just got something in my cart, and it just occurred to me. It's about $2,000 worth, and I'm thinking I can split that into two items. I go through and do that. Taxes, by the way, aren't subject to GST. So paying income tax, paying rates, paying stamp duty, paying land tax, payroll tax, if it's a tax, it doesn't have GST as part of it. Okay, so if you have an input tax supply, you don't get input tax credits. And I find this just incredibly annoying that they use the same word, the thing being input taxed. That's just the adjective that they describe the particular supply. Just means you don't get these input tax credits. So this is a technical word and phrase, and this is a technical word or phrase, but they actually don't mean the same thing. So that one probably is going to take just a few goes to get your head around. Once you do, it's real simple, and then you'll just go, wow, this is stupid. Why didn't they pick a different phrase? I don't know why they didn't. I don't know why. They could have picked literally anything else. And so New Zealand, by the way, they call these nil GST supplies rather than, yeah, whatever. Yeah. Anyway, that's just how that works. Or zero rate. So the other one, so GST free in New Zealand is called a zero rate, so it's 0%, whereas these ones are called nil rated, because you don't get the credits for it. And note that the tax office and the courts are pretty lenient. If you've got something which is some parts are input tax and some parts are GST free, they're happy to let you deem the whole thing to be GST free. In other words, that in regards to a situation where you've gone half and half, the only difference is, of course, you're not charging GST on us. It doesn't make any difference in terms of that, because neither of those things. It just means that everything you go to creating that particular thing, you'll be able to claim the input tax credits for. Okay, and these are the examples of input tax supplies. So that if you are supplying, and look, I don't know why those last two are here. They just decided for stupid reasons to put these things in. But the key thing from our perspective to note is the sale or lease of residential premises other than brand new ones. So if you're buying a brand new residential property, it does have GST. Financial supplies don't have or they're input taxed. So in other words, if you are purchasing a financial supply and then on selling it, then when you purchase it, you don't get credits for money that you've spent towards buying or credible acquisitions you've had towards creating this financial supply. This is how that works. School tuck shops and fundraising activities by charities, sure. I don't know why that's there, that just is. So examples of this are everything on the slide there. So if you are supplying mortgages or granting guarantees or having options or derivatives, or putting charges over particular forms of property, then that's they're going to be financial supplies. They're going to be input taxed, so you don't get credits in the purchasing of things that go towards generating these particular amounts, and that excludes lawyers. Aha, and also accountants as well. So that when you are creating financial supplies, the professional services that, odds are good that you guys, some fraction of the people here are going to be going through and doing, they just have GST on them normally as part of that. So then they're not deemed to be financial supplies. They're not input taxed. So you both collect GST and you can get credits normally as part of that. The same with things like FPOS systems and stuff as well, debt collectors. I think I just mentioned that residential premises, when you pay your rent to your landlord, for those that rent, or you don't pay GST, when the landlord receives money, they're not collecting GST either as part of that. There's no, they're input taxed. Which, what does that mean? It means that the person who owns the residential premises can't claim input tax credits in regards to money they've spent generating that rental income. Okay, so that's just something to note. So if you have a rental property, and Stacey knows all about these things, you can back me up on this, hopefully. They can't claim GST in regards to going through. So when you've got, you as an REA, if you're managing properties, the people you're managing them for, they can't claim input tax credits in regards to the money they spend on repairs and such like. Okay, and just, make note, brand new residential premises or any commercial property. So if you're buying and selling commercial property, that's not residential or primary production, so farms and stuff as well. That's just going to have GST normally. Precious metals. Look, precious metals are a little weird. They're weird because the first person who gets or does something with the precious metals is the mining company. What they say there is that, look, the mining company can get input tax credits when they're digging the stuff out because very Australia, your tax legislation helps miners out. However, once it's out of the ground, once you've got your gold, then passing that on between parties is input taxed. So the buying and selling, you don't get tax credits when you're purchasing gold. I mentioned this about the $1,000 limit. You have to pay this amount of the body. Has anybody had this? Claire, have you ever had that, or Genevieve, where you've had to pay customs? Have you guys had this come up? You haven't? Yeah, I've had it a couple of times, and they hold on to your goods. It's actually really inefficient too. Like, people literally call you up, say, "Oh, you got to pay $300 or whatever to this thing." Oh, okay, sure. Yeah, it's remarkably inefficient, I thought, as a process, but ultimately that's where it sits. They collect their money, and so Amazon and all of the digital services, they have to collect it if the amounts are under $1,000. So they organise that for you, and they're supposed to charge GST on top of whatever those things are. Okay. All right. Fringe benefit tax. This one, look, I hate to be the bearer of bad news, but some fraction of you who end up going and being accountants, this stuff is going to take up a lot of your time, because it used to be in the olden days that companies, employers would give things to employees instead of paying them cash. Why? Because the ATO could see how much cash you pay, but they couldn't see the stuff that was being given to them. And so that just ended up being this sort of sneaky underhand mechanism, but quite an easy mechanism to avoid tax. So the Hawke government in the mid-80s brought in the FBT system, and look, fundamentally, so like, if there's a single important guiding light to this, is that FBT puts a tax in place to make it neutral for employers paying employees the top marginal rate. Makes it neutral to either paying them salary or giving them some form of goods as benefits. All right, so it's neutral in regards to those two. So let's just say, Akil, if I'm your employer, you're my employee, and you're earning $250,000 per annum, if I give you some goods, say I give you a watch, for example, here's a nice Patek Philippe watch that I give you that's worth $1,000, the amount of fringe benefit tax I have to pay when I'm giving you this $1,000 watch is the exact amount of tax that you would have to pay if I paid you in order for me to pay you $1,000 worth of salary, okay, which would be $1,977 or something similar. So that's the amount that I have to do. So that if you're being paid more than the top in the top marginal rate, those two numbers are identical. What does that mean? It means that if I'm only paying you $90,000 per annum, you're better off getting money than you are from having a fringe benefit. All right, and that, well, sorry, when you're better off, assuming that I'm going to be paying the same amount either which way. That's really the key thing. It's all to do with the relationship between employee and employer. Is it mandatory to declare that it was given a gift? Well, okay, a couple of things. Gift, a bunch of things. We'll get to that. We'll get to that. The answer is it depends, but you'll hopefully in about 20 minutes be able to go through and to do that, because I think the one takeaway from what your question is, though, I'll just say, is that it's not the employee's job to declare anything. Okay, it's all to do with the employer. When you are being given a $1,000 watch from your employer, the employer has to pay $977-ish, we'll do the calculations in a little bit, to the ATO in the form of fringe benefit tax. You as the employee have been given a fringe benefit of $1,000. That is non-assessable, non-exempt income. Do you have to declare it? Well, technically you have to put that in your tax return, but you don't pay income tax on it. The reason why you have to put it in your tax return is to do with calculations for other areas of law. So when you're trying to determine, for example, what your whether you have to pay child support, for example. So the Child Services Agency will look at fringe benefits when they're determining how much child support you're going to have to pay. And others as well, when you're trying to determine concessional rates for superannuation. So that those things, so that fringe benefits do need to be reported on your own tax return, but you do not have to pay income tax on them. It is non-assessable, non-exempt income. All right, so here's some example of FBTs: giving a car, having discounted goods or services, provision of low interest loan. There's a variety of things that employers can give employees. And the key concept, and I'll come back to that, is that for high earning employees and employers, it's the exact same amount for giving ordinary fringe benefits. There are some exceptions, and they are for policy reasons, which we'll go into. So, that kind of reiterates what I've been saying. This bit here, that's that bit that I've sort of hammered the point. Notice I've mentioned the Walner text, which is the one we use for advanced tax, but I'm not too worried. You don't have to dig that up. Just trust me on that one. That the purpose of FBT is to make it the same for either. Now, you've got the fringe benefit tax year. It's calculated across a year, but there are installment amounts, so a bit like PAYE. And so they look at your previous year and work out how much that you paid in the previous year to determine what you're likely to be paying in this quarter. And note that at the end of the year, you then have to balance that out. So they'll either, if you've paid too much provisional FBT, then they'll send you, if you paid too much, they'll give you a credit. If you paid not enough, you'll have to pay the difference at the end of the year. The year ends at the 31st of March. So what's a fringe benefit? What is a fringe benefit? All right. Okay, more information. Going back to this watch that I've given Akil. Again, we'll go through and do the formulas for it, but if it's a $1,000 watch, I'll just put AUD 123, and it has about put about $977.14 or something like that of fringe benefit associated with it. Yellow. All right. So that will be, if it's an 8,000 watch, it will cost that much in terms of fringe benefit tax that needs to be paid. You guys can see that all right? So just as my example I had before. So I've given Akil a $1,000 watch as the employer. I also, as the employer, have to pay an amount of FBT. What does that mean? That amount is so that the total that I'm having to pay is about, what was it, $1,977.14 total. Right? That's the amount that it cost me as the employer to give Akil this $1,000 watch. Now I can still get a tax deduction. I bought something, and so I'm still going to be able to claim that as a tax deduction against my own income as the employer, exactly as if I had paid him in cash. So if I was to pay Akil in cash, in salary of $1,977.14, or I'll go through and work the amount out. It's plus or minus that. If I were to pay him that amount, if you multiply that by 0.47, magically you'll find out that that's $1,000 cash and $977 of tax that Akil would have to pay on his marginal tax return, tax rate of 47 cents to the dollar, which includes the Medicare levy, by the way. Okay. So, yeah, you pay installments. Look, if you've only got a small amount of FBT to pay, you don't have to do installments. It's only when you've got liability of about $3,000 or more, you have to start doing installments every quarter, so to speak. Right. So what's a fringe benefit? Well, you've got 12 types of fringe benefits. They're listed there. I'm not going to read them out. But the 13th type, this residual fringe benefit, is everything that falls between the cracks. That's really what that is. It's the catch-all. Some of these I'm going to talk about. The rest of them we won't. So let's go through. All right. But when we're doing these calculations, there's a few things we need to know. We need to know whether something is a fringe benefit or not. If so, what is the amount, the taxable amount of that particular fringe benefit? And we have to sort these into two different types, which I'll talk about in a second. And the reason for that is that some things that you're purchasing have GST and some don't. It's kind of annoying. But we'll get to that in a second. I'll do some calculations. What's a fringe benefit? It has to be a benefit, obviously, of some sort. It has to be in the current tax year. So it's benefit. It's got to be during the year of tax. It has to be done by the employer. Now, it can be done by the employer or at the request of the employer by an associate, third party, or any other person. Okay, but it has to flow from the employer to start with. Okay, and it has to either go to the employee or to an associate of that employee. All right, and it has to flow from employment. So if these are elements, so if one of these isn't true, then it's not a fringe benefit. Okay, as part of that. So just make note of that. It can be done by third parties on behalf of the employer, and it can be done to third parties that are related to the employee, an associate of the employee. Okay, but the benefit that's given has to flow from employment. I think the example we had was with the Nexus test for income, where the employer gave a gift to a former employee after they'd finished. That was going to be a mere gift or a true gift. It doesn't have any connection to employment. And the same with fringe benefits. If you have somebody who ceased employment and you're just giving them a gift because they're an excellent human being and they've finished being your employee, okay, that's not going to be a fringe benefit within the meaning of the FBT regime. It's just not. All right, what's a benefit? A bit like supply in terms of GST. It's given really, 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 really broad terms. So it's rights or interests in real or personal properties, privilege, service, or facility. But if it is a personal relationship, right, and there's no connection to employment, it is a mere gift. No FBT arises in regards to mere gifts. Now's where things get interesting from an accounting perspective, because going back to this example of Akil, who earns $200,000, or say you earn more than that, say you earn $300,000 per annum, okay, and it was $1,000 worth of with a benefit, yeah, $1,000 worth of benefit, and what's that? 1,977. So like it's got decimal points in it. Here we've got $1,000 worth of benefit to Akil and $1,977 cost to provide that benefit. However, if you are giving your employee an exempt benefit, okay, that is not going to be subject to FBT. So if a keel is on the top marginal rate and you provide healthcare, recreation, and childcare through in-house facilities, if you do expense payments that relate to work-related items, if you pay for membership to trade organizations and subscriptions, or airport lounge membership, have taxi travels to and from work, okay, and or I said in-house fringe benefits. We'll come back to that. If you have these things and you're giving them to your employees, if you, in theory, rather than having a situation that like we had with Akil where he has this, oops, where's my thing gone? Come on, get it. What? Can't do my drawing. There it is. If you give somebody an exempt benefit, Gil is still going to get the same amount of benefit out of that. You're still going to get a $1,000 laptop. You're still going to get $1,000 worth of healthcare. What's the big difference though? What does it cost the employer? Exactly. And so from the employer's perspective, it only costs $1,000. So if the employer, the same employer, is willing to pay the amount that I'd earlier had, which was the $1,900 and what have you, then that is the amount of benefit that the employee is going to have. That's the key thing to note about exempt benefits. That is why, if for policy reasons, the federal government has set up this list of things that are exempt to actively encourage employers to go and provide these things. We want people to provide these things, and we will give you the benefit of it being a one-for-one. There's no FBT on it, so you can do this in lieu of salary, particularly for high income earners. Doesn't make quite so much difference for very low marginal income earners, because if you're on the very, very lowest tax rate, you're in the tax-free threshold, it makes no difference at all. The same benefit in cash is the same thing. However, for every other employee on a marginal rate between 18,200 and higher, you're going to get some form of benefit from this. Does this make sense? Because this is really the like a fundamental concept in FBT. For policy reasons, we want people, employers and employees, where you've got employees that are earning a lot, for the employer to provide some form of childcare or healthcare as part of that. If we encourage employers to do that, particularly for people, and let's think about that, people who are, and feel free to take this the wrong way, if you're earning, or if your employer is willing to pay you $350,000 to do something, and you have to take weeks off to look after your kids, is that good for society? Or is it better to keep you working for 3 weeks and have childcare? Have your employer pay childcare for that? And the answer, from a policy perspective, is probably the latter. Okay, does that kind of make sense? That's really this thing here. We want people to purchase, for example, electronic devices, software, briefcases, tools of trade, so people go to work, so people are able to go and have healthy, functioning time of working more. That's good for society. So that's why we have these exempt benefits as a result. Yeah, so that's where we're at now. There are some other types of things. Look, for technical reasons, salary and wages is clearly not fringe benefit. That's cash. The same with allowances, share schemes, and so on, and superannuation and so on. They don't fall under the FBT regime. All right, let's do some calculations. Yay! Oh no, not quite. All right, there's a couple of there's a couple of ways that fringe benefits, or the amount that you're going to be taxed on, so that's the $1,000 that we're looking at before, is going to be reduced. All right. The most obvious one is recipient contribution. I know it sounds really obvious, but it needs to be said nonetheless. That if, for example, Akil with this watch, if he paid 500 and me as the employer paid 500 for this $1,000 watch, clearly the employer is only going to be paying FBT on $500 benefit that's provided, which is the 1,000 less Akil's contribution. That's pretty straightforward. There are some particular rules for specific reductions we'll talk about, but this first one though is a little bit tricky to get your head around, which is the otherwise deductible rule. And it goes like this. If you provide a benefit to an employee, okay, they are in regards to that particular thing. So for example, I provide, Stacey, I'm your employer, and I provide you with, laptop's a bad example. Let's say, Stacey, you've got a consulting business. You consult to the, what are you in these days? You're not in real estate anymore. I've forgotten. Insurance? No. Healthcare. You're in healthcare now? Can't remember. Either way, recruitment. Okay, that's okay. Good. All right. So let's just say that you're moonlighting. You've got a double job, and you're my employee in regards to, I don't know, Macca's or whatever. If I give you a benefit, all right, and that particular object, I purchase, for example, God, I don't know why I'm having a hard time thinking about this. Oh, I pay to repair your office for whatever reason. I'm your employer, and you've got your own office for your own business, but you spend 25% of the time working for me. Like, well, one day a week, you come and work for me. If I pay to repair your office where you have your own business, all right, can you get a tax deduction for that? This is a question for everyone here. If you've got your own business, you've got your own premises, but someone else comes and pays for your repairs, can you get the tax deduction? No, definitely not. Someone else paid for it. No, definitely not. And so what they're saying there with this otherwise deductible rule is that if you, technically the payer only if it's an outgoing which they can claim. So that if I'm paying for it, I'm only going to do it if it's something which is necessarily incurred in running a business or directly incurred in deriving income. Now, however, the tax office doesn't care how you run your business. So ultimately, if I, as my employer, I'm employing Stacey to do my recruitment stuff for one day a week as an employee, all right, and the other 4 days a week she has her recruitment business. If I repair her business premises that she owns, she can't get the deduction because she didn't have any outlay. I probably can get a deduction because it's something necessarily incurred in running a business. The tax office doesn't care how you run your business, but that's not really the relevant point. The relevant point is that Stacey loses the benefit of getting a tax deduction for that same thing. And so as a result, if Stacey could claim the particular benefit as a deduction, the amount is not subject to FBT. This one takes a little bit of getting your head around because it comes up in more sophisticated situations. Because usually when you're giving benefits to employees, they're usually nice things that they aren't able to claim as a tax deduction themselves. Now, like Akil's watch, for example, it's not going to be able to claim a watch as a tax deduction. Whereas if I, if I paid for something that involved with his business, like I repaired Stacey's business premises, then you're losing the tax deduction. And so that's how that is. So that's it. So because that's what the otherwise deductible rule is. However, it only applies to one-off payments. It doesn't work if I was to pay Stacey's electricity bill for her business. Okay, if it's only works to one. And to be honest, I don't know why that is. Could probably have some guesses, and that it looks more like the nature of income or what have you. I'm not sure, but the otherwise deductible only works for one-off payments. Doesn't work for regular expenses. I'd have to delve into the history of why that is. Okay, next thing. Calculations. Okay, this is where things get really fun. To do FBT, you have to know this distinction between what we call type 1 and type 2. What's type 1? Things that are subject to GST. The reason for that is that if you are giving somebody an object, so a keel, for example, if I'm giving a keel a watch, all right, I get to claim input tax credits for purchasing that watch, all right? However, if the particular thing that I had purchased is not subject to GST, all right, I don't get to claim input tax credits in regards to that. Therefore, this benefit, I'm not getting as much benefit from it as what I would normally do. So the amount of tax I'm going to pay is going to be less as a result. That's just how that works. Okay, so, and this, when I say not subject to GST, that includes both things not subject to GST, that aren't have GST, as well as input tax things and GST-free things. So if any of those things come up, you're going to go and buy. If I go and buy, forgive me, Akil, a medical health checkup, for example, checkup or yeah. And so I was about to say cosmetic surgery, but no, the cosmetic surgery is subject to GST, so that doesn't even work as an example. But that, and so that, look, the reason for this is that when we get to this calculation, it's to do with these steps. So I'm going to read this, and then I'm going to do some examples, which is this, because you basically, there are two numbers. They're on the next slide. So I'm going to show you what those numbers are. Don't get scared. Don't get scared. Oh, sorry, that looks a bit messy. It's these two numbers here, by the way. These are the only things you need to remember. It's this one and this one. This slide just shows you how we calculate those, how we got there. And in that formula, the FBT rate and divided by GST, all that, blah, blah, blah. Don't worry about that. You just need to know, you take the amount, this is the stuff that has GST in it, multiply it by this to get that what we call the grossed up value. Once you've got that number, you multiply that by the FBT rate. What's the FBT rate? It's 47 or 47%, so 0.47. That's how you work out how much fringe benefit tax you have to pay when you are giving something to your employee. In regards to things that don't have GST, it's this amount. So we would take, in the case of the watch, we would just take 1,000, multiply it by 2.0. I should probably have done this with text. What does that equal? Well, it's pretty easy, really. That's 2,080. Good God, Simon, $0.20. Then we multiply that by 47%. What do we get? 2,080 20 by 0.47 equals oh good God. Okay, that didn't go very well. It was sorry about that. I think it was that. How about that? That's better. 977.694. So it's there we go. So that's the amount of FBT, which was close to what I had before. I couldn't remember the decimal point. That's going to be the amount of FBT that we would have to pay on that $1,000 watch because it's a type 1 amount. If it was a type 2 amount, so instead of buying a watch, I paid as rent. There you go. I paid your rent for a week of $1,000. Nice house to pay $1,000 worth of rent. In which case we would have this second number here. So that would just be 1,000. Sorry, 1868 times 0.47 is that amount there, which would be a bit less. That amount. 870. That's about $100 less. So there we go. That's literally that's all you got to do. That's what you got to do. I know the numbers end up being messy, but that's functionally that's all you've got to do when calculating FBT. You take the type 1s, you do them. Take type 2s, do them. So you do the gross ups, by the way. Then you just add those two numbers together, then multiply them both by 47%, and you'll get the total amount of FBT you've got to pay. And so I'm still building the quiz. I'm actually quite a bit behind. I was hoping I was going to get ahead building the quiz for this one, but there'll be a few questions like this in it. Where you have to go and identify type 1s, identify type 2s, identify things that aren't subject or that are either exempt from FBT, throw them together, multiply by 47, and that'll be the amount of tax that the employer has to pay. Okay, now going back to this fact that it's a negotiation between employee and employer. So going back to me and Akil with this, he's earning $200,000, $300,000, and we're talking about fringe benefits. And ideally, we can reach some arrangement where I'll, if you want to be paid a bit more money, I can do that in the form of an exempt fringe benefit. And that works really well. However, what if I don't want to pay any more money? I'm already paying him $250,000 per annum. Well, you can go to your employer and say, pay me less. That is a salary sacrifice arrangement. Hey, how about you pay me less, but you put that money towards a certain type of benefit? Now, has anybody here worked for Queensland Health or for any community legal organisations or anybody done that? Because I was horrified. Well, not horrified. I mean, baffled at first, but so the health. I have friends who are nurses and they don't salary sacrifice, and they are just doing life wrong because it's free money. All you're doing is you're taking amounts that you and start again. I was doing QPilch Law Right community legal here a few years ago, and the lovely lady, she's a lawyer that run these days, Sheree, she was talking to the payroll people for this organization, talking about how she was salary sacrificing her rent. And I'm like, you can't salary sacrifice your rent. Get out. Turns out Queensland Health employees, through a deal they have with the federal government, can salary sacrifice their rent. I've got no idea how this works, but they were able to do that. So if you can salary sacrifice an amount in order to pay for an expense that you're otherwise going to pay, what's the big advantage to you in terms of doing that? Salary sacrificing, say, each year $10,000 to go towards your rent if you're allowed to do that. Because the reason why you can do this, by the way, is that Queensland Health and the Queensland government have a deal to pay all the FBT. That's right, in regards to these things. Why would you do a salary sacrifice? What's the big advantage to you? So Akil, if we do a salary sacrifice where you agree to reduce your wage by, say, $10,000 per annum, and I put the $10,000 towards that, yeah, you're paying income tax of $10,000 on $10,000 less. It's reducing your assessable income. It'd be crazy not to do this in a situation you go through. It is literally free money. Would you like to pay more tax or pay less tax? And for literally no difference in life. That's why when I found out Cherie was able to do this, I was like, what the hell? Why? And my friends who are nurses, if ever you're listening to this, you should definitely be salary sacrificing to the hilt. You're just crazy not to. Okay. One thing to note though, must have entered into the arrangement before the wage is paid. You have to actually do that before you actually earn the thing. You can't do it retrospectively. Okay, now we've got some specific examples. Cars, you know, we were doing cars and doing depreciation. And look, cars are a little bit they're, because it was such an easy thing for employers to do back before 1986, it happened a lot. Now they've really tightened down on it. And so it's got broad definition. The employer doesn't need to own the car. They could lease it and just give it to the employee or an associate of the employee. So note that is, it's just to do with the employer choosing to allocate cars to employees. You pay FBT on that. If you're giving cars to people, even if they are work cars, some fraction of that is going to be for private use. You have to pay fringe benefit tax on that. As part of that. So that the amount, which we'll get to in a second, note that utes and taxis and so on like that, where they've where you've gone and you're giving your if you've got a work ute and you're giving it to an employee and they're also using it for work related purposes elsewhere, that doesn't have FBT on it either. All right. So there's two formulas we can use for determining how much FBT we've got to pay when we're giving a car to an employee. The first of these, the statutory formula, is this one here, which is this. It's the base value of the car. Now, you may recall the car cap, $60,000. Do you guys remember that from when you're doing depreciation? Does this sound familiar when you're talking about the car cap? So that you, yeah, it's about 60K. It's indexed every year. Do you think that applies here? Let's put this to a poll. Do we think, or should the, and it's got approximately 60K car limit, apply for FBT purposes? This is the quiz. I'll put it in the, that to a poll. There you go. For all those that are playing behind, watching the recording afterwards, because it has the chat. Should the car limit apply? We've got one brave soul. Two brave souls. Should it apply? Well, three. Oh, Rizvi. Stacey, what's your thoughts? Oh, she might have popped away. She's been a bit quiet. Oh, yes, as well. Okay. So if we stop and think about this, the car limit in terms of depreciation. Oh, unanimous. I'm playing with the puppy. Yeah, sure. The car limit of depreciation means if you go and buy a Lamborghini, you can only claim a tax deduction for as if the car cost $60,000. Okay. If you give a Lamborghini to your employee, is it appropriate that the FBT is calculated only from a $60,000 vehicle? It's that moment where you guys are going, oh, yeah, no. And it's funny, it's all to do with how these things are phrased. So there definitely doesn't have a car limit in regards to FBT, because the that's the limit. Yeah, there is no limit. No, there's no limit there. If you buy a $200,000 car and you give it to an employee, you're paying a stack ton of FBT on that. And look, it all comes down to a lot of these things being something that we all have. We all have cars. We all have cell phones. We all have houses, and and we all eat food. So as a result, they really try and tighten down on people being able to abuse this, because they don't want to be checking up on you as well, as part of that. So look, again, obviously you've got the recipient contribution, but leaving that aside, so if you pay towards it, but it's 0.2. So it's the number of days provided. So if you're giving somebody a car for the entire year, it's going to be literally 20% of the car. All right, that's going to be the taxable value of the car. Okay, it includes stamp duty and includes rego as well. All right, that's the taxable value. It doesn't include fuel. Fuel, that's a different thing. But that is quite a lot. If you're giving somebody a new car, say you buy them a $100,000, say maybe a $50,000 car. So $10,000 each year is going to be the taxable value, and that's the base value as well. So that's just something just to note. Okay. Whereas operating cost, this is one where you have to go and check, because that day's held, by the way. There's no kilometers. You have to keep a logbook for that. It's just the days you had the car. Did you have the car for this day? Yep. Doesn't matter if you did 2 kilometers or did no kilometers. If you had the car as the employee, the benefit was provided on that day. Whereas for the operating cost basis, you've got to calculate the business use percentage as part of that. So that's just one thing to note. Does the base value I actually don't think it does. I have to go and check that. I'd have to go and check that. I've got it because I foolishly removed that slide from the advanced tax. So you do that one again. I actually don't think it does. I actually think it is the base value stays for the whole time. So it's not going to go down. So the amount of, if you have a car that's $50,000, I know, yeah, I know, it depreciates. So in theory, the benefit would be less, but I actually think it doesn't. I'll check that. So I genuinely just don't remember. I could put that in the recording. Yeah, I didn't think so. Base value. Yeah, it is. Base value is. Wow. Oh, okay, there you go. So you don't reduce it. Here you go. You love this. I didn't remember this rule at all. So you don't reduce the base value of the car each year. However, you can reduce it by 1/3 after 4 years. Okay, so there you go. So that's how you go through and do it. I had no memory of that rule. So I'm actually glad we checked that. There we go. So make that one there. So by default you don't. After 4 years you can chop it by 1/3. Okay, and so here we go. Operating cost is just the cost to run it. So the cost to run that particular car like that, and that includes repairs, fuel, and all sorts of bits and pieces. And that does have the depreciation, the statutory depreciation rate as well as part of that. And if you were borrowing money for it, operating cost includes interest, but it's a fixed amount, which I don't have here, although it's probably on my statutory percentage. Oh, here we go. Pop that into the chat because it's on the same. It's on the same ATO help. That one there. You can have a little read of that one there. Anything that's not on the slides here won't go in your assessment, by the way, because otherwise we just go down that rabbit hole. I said, and I've pulled these slides out, but I haven't taken all of them from the advanced tax. But I don't actually recall that being in there either. It might be, but I'll go back and go check. Okay, all right. Next, expense payments. If you pay your employees' expenses, and again, this is assuming the employee is not deducting those, because otherwise the otherwise deductible rule applies. Just make note that if you are paid a fixed amount that's predetermined, all right, that is an allowance. So for example, if your employees, you've got to pay for them for meals or a meal allowance, for example, that's an allowance. That's just salary. That's not a fringe benefit. Expense payments happens where they go and your employees are paying something or reimbursing amount that an employee has paid somewhere else. And remember, this is paid somewhere else in a situation where it's not tax deductible. so that the particular expense can't be taxable. So an example might be paying a fine. Okay, so that is something that is not tax deductible as part of that. So your employer can pay that. The employer isn't able to deduct it either. I've got to point that out. So it's just a triple whammy in regards to that. But they could still go through and do that. They'd have to pay FBT on that, and they wouldn't be able to claim a tax deduction. They would, curiously, I actually believe they'd be able to claim a deduction for the FBT, but not the penalty itself. So that's something that you could go through and note. But and because the employees, once you've had something paid for, it's like Stacey with her repairs, you can't claim a deduction if you've had something reimbursed. You didn't have an outgoing. That's something that, even though it probably doesn't need to be stated, it is stated in 51 AH in the old Act. Oh, this one's really annoying. Car parking. Look, I'll tell you what these rules are, but I don't think they're going to be around for much longer. And they've materially changed this law. So you guys probably where the budget came out last night. So when we're doing superannuation, there's a whole bunch of changes that have come through. So yeah. Okay, so turns out if you give your employees a car park, that's a fringe benefit. I know, right? Doesn't seem very fair, but it is ultimately. And so what they've done is that it used to be that most employers, this would be fringe benefit. Now they've changed it relatively recently. Only large employers. So only large employers, so turnover exceeding $50 million will this come up. And it's only going to come up if their turnover is more than that, so they're big, and they have a car park for their employees, and nearby, so within a 1 kilometer radius of that car park that's provided, there is a car park, commercial car park, that charges more, and this is an indexed amount, than about $10 a day for an all-day fee. So if all of those things are true, that is a fringe benefit. Why does this exist? It exists for people or entities who have inner city car parks. Where I just saw a little thing on the internet last week. Some woman saying that a car park in downtown Toronto, wherever it was, earns $27 per hour, and me, as a fully fledged human beings with emotions and needs and feelings, earns less than a car park. That's true. True. You guys, Claire or Jen or Akil or Rizvi, if you're still there, have you guys ever gone to a central city car park in central Melbourne or Sydney or Auckland or possibly Brisbane? Have you guys ever paid for parking in there? Because I used to pay, and this is like 20 years ago, and it was $18 an hour. So when I'd go to my lecture, I was so annoyed sometimes when you'd be waiting in the queue and the person would wait for the queue and then it would tick over. So then you have to pay another $18. It turns into a $36 exercise. I was so angry when they wouldn't let me off it. Oh, I was so angry. Anyway, arguing with car parking things. Yeah, it doesn't go well. So that's a rule. It just is. Look, this is the sort of rule that it looks like it's been left in there for sort of equity and fairness reasons, but I don't know what'll happen with that recent times. But changing it to $50 million employers puts all the compliance costs onto large employers, which I guess is probably a good thing. Oh, all right. So that's the end of FBT. I'm going to move on to the next area. This is excise. There's not much here. Basically, you just need to know excise is something that goes on 3 types of products: booze, tobacco, petrol. That's it. That's it. That's what we put those things on. And we'll notice that as of last night, they're going to chop or halve the fuel tax. And look, it's so central. I've been in Australia a long time, so I've seen the highs and lows. I've seen both sides of politics do stupid things. This government, this particular government, so the Morrison, the post-Turnbull, so the Morrison government, and in regards to economic policies and the level of corruption is just beyond the pale. And I'm saying this as a foreigner. It's outrageous. I cannot believe how badly and a whole variety of metrics that aren't reported by, thanks Uncle Rupert, haven't been reported, and I found it just painful in terms of the rorts, the level of corruption, and to watch this budget where they're just ballooning the deficit to have election bribes with no clear, coherent reason for any of them other than we want to win, we want to bribe the public to win election is, sorry, end rant. Anyhow, the price of petrol is about to go down by 20 cents per litre, or sorry, the excise is going down by 20 cents per litre. The price of petrol might not, because that's ultimately is a private decision amongst private entities. They're not government entities, so they're chopping the fuel excise and purportedly to lower fuel prices. I don't think it's going to, and much, well, will do a little bit. And you as the taxpayer are going to have to pay it anyway, because it's tax. Yeah, I'm so angry. Sorry. But if anybody's watching this afterwards, I'm getting all worked up. End rant. Wine is different. By the way, wine is taxed differently. It's got a variety of other taxes. Take out next days. So you got booze goes, and these things, by the way, then, which is on the next slide, they have different mechanisms for indexation. So this is really interesting, actually. You notice that tobacco is indexed according to weekly earnings, whereas booze and petrol and the CPI. Why do you think that is? There you go. Here's a question. Let's put your thinking caps on. Why those two products are indexed at using different indexes? And as business students, you should know what both of those things mean. Say it again. Why do you think tobacco is indexed according to average weekly earnings, whereas alcohol and petrol are indexed to the CPI? Yeah, for policy reasons. Why do you think? Ooh, maybe this could be an exam question. And this is going to seem pretty awful. Who smokes? Is that something that is done uniformly across society? No. Are people who derive income from property and or business likely to be the people that are smoking? It's quite an awful thing, actually. This is a class-related rule, essentially. Really, that's what it is. So that's what's one of the sort of sad indictments. And look, I mean, I'd go back to the history of it, but you can back this up with a variety of data, but it's well, it's more that you're more likely to be paid in wages. That's the sort of the key takeaway, in that there's a correlation between those two things. So that's that's certainly a reason. There may be other reasons, but that's certainly one. And that's really for you guys to think about, because ultimately, yeah, I'm going to teach you all the stuff and tell you, make you jump through hoops and do all these quizzes and bits and pieces, so you're going to functionally know how tax law works, but knowing the why. And this particular topic is a bit more about the why, because this is non-income stuff. So you have to think a bit outside the box. Note that the budget changed the fuel, but they actually don't need to pass legislation. The tax office can, I think they're not changing the fuel until the legislation goes through anyway. But if, for example, if the government had announced a week ago they're going to lower it, they could have got the ATO to lower it straight away. They actually don't need to lower or raise duties, these rates. They can actually just do it by giving notice, or say giving notice, just publishing it on their website. So the ATO could go through and do that if they were told to do so. Okay, customs is kind of like excise, except it's on imports. Okay, it's on imports. So the customs, they're the ones that put those things. There are also a variety of other forms of duties that go on things as well. So these additional ones are usually in the form of what we call tariffs. So you're purchasing something from a place where, for whatever reason, the Australian government's chosen to protect local industries. You can put tariffs on it. And look, there's this whole push globally over the last sort of 30, 40 years to try and reduce tariffs between nations. In theory, that globalization makes everyone better off. This war in Ukraine is probably, in fact, commentators have actually said, this war is probably going to lead to the death of globalization as a phenomenon, but that's political discussion outside the scope of this. So just make note that duties on booze, smokes, and petrol are the same as the excise rates, but there are additional tariffs that they put on customs duties that they impose on other items. All right, now we're going to do some state taxes. So this is only real brief. It said if you do advanced tax, I'll go over all of the stuff we've done in this section other than super, we'll go over, but it's spread over 2 lectures. So quickly, land tax. This is an interesting one. It's not that interesting, but relatively so. There's a few little gotchas you can get from this. One is that land tax is an amount which is on the unimproved value of land. Okay, that's the first thing you need to know. Second thing you need to know, it's assessed annually and super important. Stacey, do you pay a pro rata amount depending on how long you've owned the land over the course of the year? You may not know this when you're doing REA stuff. Is it pro rata? So if you own it for 3/4, you do not know. Well, I can tell you it is absolutely not. If, as at midnight on the 30th of June, if you own land, you are liable to pay land tax. That's how that works. It's a one-off just on that date. Okay, that's the second thing you need to know. Third thing you need to know is that your house, your own house, the house you live in, or if you're a trustee and all the beneficiaries use it as a home, then it's exempt from land tax. It doesn't go towards the taxable value. Okay, but leaving that exemption aside, so if you've got the house you live in, you just leave that aside. Add up the value of all of the other houses that you own. So you as an individual, resident individual, you add them all up. So say you've got, Stacey, you've got 3 houses and they're worth $1 million. The land value of each is $1 million. Okay, so that would just be, that would just literally just be $3 million worth of things. What you do is you would take away one, what was it, 600K. And you see you would have AD. Let's just say you own 3 properties with a land value. Again, there's not buildings, just the unimproved value of land. Those are 3 pretty expensive pieces of property. And let's say you own them in one in Melbourne, one in Brisbane, one in Sydney, and in inner suburbs. They're all $1 million each. Actually, it's got to be in Queensland, right? That wasn't a good example. Let's just say you own 3 pieces of land inside in Brisbane, and their total value is $3 million. Each year you will be assessed on $2.4 million to pay land tax on. Okay, that's as an individual. If you held those as a company or as trustees, or if you're non-resident, so you live outside the state of Queensland, then the threshold is not 600,000, it's 350,000. And there is a really important gotcha. It's super important because there's actually a very easy workaround in regards to these things. Doesn't quite come up. It's not quite so important when you've got $3 million properties. But let's just say instead of having, you're going to love this, instead of owning 3 $1 million properties, let's just say you have 10 times $300,000 properties. Okay, so it's still the same amount, right? Make sense? You with me? You guys with me? Just get a little ping. So, yep, still going. Okay, good. Well, hilariously, if you put those in trusts, all right, the way it works is that because you're adding up all of the amounts that are owned by that entity to determine the taxable value, then you're going to be paying an amount, right? Trusts. You guys are aware that trusts, you have trustees and you have beneficiaries. So for the purposes of land tax, a trust with a different list of beneficiaries is considered a different trust. So I'll say that again. For the purposes of land tax only, where you've got a trustees and you've got a list of beneficiaries, if the list of beneficiaries determine the uniqueness of the trust. So let's just say everyone in this class, sorry, don't take this the wrong way, class, but let's say you're all my children. I've got 5 lovely children. Or say Stacy has 5 lovely children and she has 10 properties, what you could do, I kid you not, is you could set up one trust which has 4 of your children and misses 1. And then another trust which has 4 different children and misses 1. And then you can set up another trust which has 3 children and misses 2. And then another trust which sets up those 2 and puts the other 3 in. Provided each of those trusts, you do have 5 kids. Really? You've been very busy for a 22-year-old. Hey, Stacey, can cats and dogs be beneficiaries? In Petnol's case, Petnol, can they be beneficiaries in the UK? They can in the UK, they can't here, no. Soz. So basically, I know it sounds like a real dumb rule. I've got a friend of mine actually studied law 12 years ago, and he went and did it properly, went off and actually became a lawyer, now owns all of this property and puts them all in, he's got 3 kids, puts them all in different combinations of trusts for each of the items of property that he has, commercial property. Look, don't get me wrong, it's a lower threshold. So you've got, it's 350,000, but you can move them around, and that's quite a common vessel for doing that when you've got a variety, when you've got many pieces of land that don't have a massive amount of underlying land value. Okay, there you go. This is something you need to know about land tax. All right, got land tax rates. They're here. This is for individuals. This is the sort of thing I'll probably put in your test. So the first $600,000, nothing, and then it's progressive. So it's 1% up to $1 million, 1.6 beyond there, and so on and so on. And so each of these, so if you add up all of these up to this point, so up to $3 million, it's then going to be that amount, and so on. So everything up to here is going to be this amount, and so on. So just make note. That's why they've written it out like this. And when you've got property that's worth more than $10 million, yeah, that's where we're at. So it's that amount. Okay. Yeah, that's just the rates for that. And just note, before I continue, just note that this fixed amount here, that $500, by the way, kicks in the moment you hit 600,000. Okay, so note there is a flat amount of 500, and then you've got to add these progressive amounts as part of that. So just be a little bit mindful of that. So that when you're doing these scales, literally look at where they're at in the scales, look at the amount and use this dollar, the dollar value there, rather than trying to do it as a formula. Okay, and for non-individuals and yeah, so for companies, trusts, and non-resident individuals, there's a few more rules. We don't need to know those. That's the rates are a bit higher. Okay, that's land tax. Payroll tax. Trying to learn Australian payroll 20 years ago when I worked for a payroll place was really, really hard. We're just like, wow, all of these things. We have PAYG instead of PAYE, and you've got all of these things with awards. We had no concept of awards, by the way, no concept of NES or enterprise agreements, no concept of any of this. One other thing we couldn't understand is the difference between states and federal taxes, and we did not understand payroll tax, because payroll tax is an amount that's levied on employers if they hire and have a lot of staff. It's basically when you pay in a year more than $1.3 million. Once you hit that, you've got to pay an amount only above the threshold. So you're only paying this amount, this percentage, 4.75%, of every dollar you pay in wages beyond that threshold. Okay, so it's everything beyond that threshold that you have to pay to the state government. This is a Queensland tax. Note that if your annual wages bill is more than $6.5 million, this percentage goes up, but it doesn't go up progressively. It's so you'll 6,6.499999999.99, you'll be paying the lower rate. The moment you pay one more dollar, you'll have to pay that of, it's not quite the entire amount, it's the entire amount less this, the 1.3. Okay, that should be pretty straightforward. Why do they do this? State governments are broke. They're just trying to get money left, right, and center wherever they possibly can. Oh, that's it. That's all you need to, what? Yeah, that's it. That's all you need to know for payroll. Payroll tax, stamp duty or transfer duty. Look, it's called transfer duty everywhere in the legislation. It's called stamp duty by literally every person in practice, both legal practice and accounting practice. So stamp duty is officially transfer duty. And certain transactions, you've got to pay a percentage like that. Again, it's a state tax. Why do they have it? Because it's easy. It's easy to administer, it's easy to pay, and very hard to avoid, because the biggest place you get stamp duty from is the transfer of land. When you transfer land, you got to pay stamp duty. The purchaser is the person who has to pay the duty, not the seller. All right, so these are situations where stamp duty is going to arise. So you've got the transfer of dutiable property and motor vehicles. They're the ones that come up the most. But you also have to pay it for insurance. When you create trusts, there's a massive, massive, massive loophole for that, which I'll tell you about now. In fact, I won't get. I've got my own trust deed floating around. Stacey, I didn't teach you trust, did I? Oh, you went to class though. You went to class with Maddie. So in trust law, I taught it when Tom was not well a few years ago, and so I got my own trust deed, changed the names, and gave it to the class, gave them as their first tutorial, was to go through and solve a few problems. One of the things that you guys as accountants, accountants will be doing is stuff involving trusts, which is hilarious because it's very much something you only learn in a law degree. As a person that did both, we were grossly unprepared in my business education, both undergrad and postgrad. Really, really underprepared in terms of learning how trusts work. And one thing from a practical perspective, to set up a trust, you literally, as an accountant, often you're going to be the settlor. The reason for that is there's some anti-avoidance rules and tax, which when we do trust law, I'll talk about. Can't remember the case from the 70s. But basically, you will pull a $10 note out of your pocket, and that will be the trust. And from a practical perspective, when you create a trust, usually you go and actually get it stamped. You should go, give it to the tax office, get them to stamp it, the Office of State Revenue, get them to stamp it to show that it's been done. You pay a transaction fee. It's not you pay $0 stamp duty, but you pay like $38 worth of fee to the government for them to put the stamp on it. And that is now your trust deed. It demonstrates that it's been seen by someone and there's a copy of it, a record of it with the OSR. That is different from transferring the house into it, because when you transfer, when you create the trust, if you don't do it in those two steps, when you create it with the house or whatever property you're putting in it, you're going to pay stamp duty at that point in time. The reason why I did it that way, with a $10 trust first, then transferred the thing in, was because when you transfer property in a family law property settlement, it is exempt from stamp duty. It's super, super, super important rule for those that end up in having to give financial advice, and for those that end up doing anything near or close or arranged to family law. Okay, very important rule, because stamp duty is quite a lot. So I'll just get to in a second on the next slide. But note that if you can't cheat on it, the dutiable value is either the value of the property or the consideration paid. It's going to be the higher of those two things. So if you try and sell something at an undervalue, it's whatever the property is valued at is going to be the amount you have to pay stamp duty on. So you can sell your house to your cousin for $1. the office estate revenue don't care. They're still going to charge you the market rate on that house for stamp duty. The rates are here. Note you actually do this on motor vehicles as well. When you buy a house, you've got to pay to the office estate revenue. When you register your vehicle, you pay to the Transport and Department of Main Roads and Transport, or whatever they're called. When you go to the rego place, you pay this. So that's why your registrations. When you transfer a car, you've got to pay a decent sum of money as part of that. So there we go. So it's up to $5,000. You don't pay anything. And then it's a progressive amount, 1.5%. Then 3.5% for every dollar above 540. And then above $1 million, it's 4.5%. You can see how these things are going up. You're buying a $2 million house. You're going to have to pay, what's that? This plus that times, so you're paying like 90 grand worth of stamp duty. It's a non-trivial amount. And it's easy for the state government to get that money because you can't avoid it. Okay, that's how stamp duty works. Excellent. Rates. Who here pays rates? Claire, you have to pay rates, don't you? I don't know whether Stacey's about to be paying rates. Okay, so look, the word rates is not a very good word, but that's what we use. Not yet, can't wait. Yes. So sometimes it's rates and charges. Sometimes it's called council rates or just rates. That's what they call local government rates. It's an amount. Look, it's actually technically split into 3 different amounts. There's a services one, which is the general rates. You've got special rates and you've got utilities. Now, technically, utilities is a charge. It's mandatory, but it has to be for a specific amount involving waste management. It's actually not technically a tax. That's just a recoupment. Now, look, they've got broad scope in terms of how they define those things. Oh, look, hey, we need to build a new sewage plant, which is increase the utility charges. But by and large, that has to vaguely be associated with the actual amount that they charge. Now, rates are charged on the improved value of buildings. So where we looking at land tax is on the unimproved. Rates is charged on the improved value of land. That's general rates. Okay, and general rates are across everything, and it goes to the council, and the council spends the money generally. They can, however, create special rates, all right, so that the council's given power to charge particular packets of land, or the owners of particular packets of land, things where there is a special association with that land. So, for example, they could, down in Douglas, for example, have special rates in regards to the additional lovely little tracts of native bush and the extra care, for example, that has. They could charge special rates. They don't in Townsville, but they could. Whereas general rates, first of all, general rates, by the way, must be levied. They actually can't, council can't choose not to levy rates. They must do it. Okay, and they must do it in all buildings. So it's any land or building, which is not exempt. Council can't choose. They have no statutory power to not charge you rates, or at least general rates. Special rates, they get to go and define that. And here, in this case, it was heard of in Townsville by Justice Carlane a few years back, Burdekin Shire Council. They can set these things up. You aren't allowed to set it up so you literally are charging one person just because you don't like them. You can't do that. It has to be used reasonably as part of that, so that they have to have a reason for charging one person. And functionally, that's what happened with the Sunwater. They were charging one ratepayer, Sunwater, a high percentage, way higher than what all of the other rates were. And I think Sunwater won in that case. And the Justice Carlane, judge, who the moot court and everything is named after here, he said that, look, you can do this, but it's got to be done reasonably. Here, this wasn't reasonable. You've got to show why you're charging these special rates and utilities far higher than other places. So that's rates. I don't know if you have any questions in regards to that, but we'll carry on anyway. Okay, right. Superannuation, just what we need this time of night. What are we? Coming up 8:30. I don't think we'll take a break. We'll just go through and finish all these, if that's all right. Super is huge, and it changes all the time. I've literally got a sheet of paper that Steve's handed me with changes that have happened since I published these because the budget was last night. Yeah, let's go. Super is massive. This number is the reason why you will, if you are doing accounting, you will need to know how superannuation works because of that number there. There is about $3.5 trillion in super. And the purpose of super is for Australian individuals to save for their retirement. And one of the policy things you'll find is that they want to encourage people to put money into it, but not too much. So you get tax incentives for putting things into super, but there are disincentives for putting too much. So more than $1.7 million into super because it's a tax preferred strategy. Okay, and super can either be in terms of a fund, which is defined under the statute, or a trust, which is defined in the general law. And so you have providers, statutory providers or trustees that have duties to look after those things. And they're the ones that have the duty to pay tax in regards to things involved with the trust for the income that's generated from that particular fund. Usually you have professional managers go through and run those funds, particularly big funds, but you can, and I have not talked about it very much, you can have SMSFs. What's an SMSF, Stacey or Claire? Oh, it's that. Self-managed super fund. So you can do it yourself. I talked to Steve about this a while ago, and I asked him how his SMSF's going, and he laughed at me. He's like, I'm not going to do that. Waste of time. Why? You've got a whole bunch of compliance you've got to do for very little benefit. And admittedly, over the course of his life as a full professor, he probably was going to hit $1.7 million pretty easy. And look, you will, if you're going to do accounting use things, because people do have them, and sort of thing that as an accountant, you'll get a lot of work out of it. So knowing those rules, I haven't gone into it here in terms of SMFS, but note that there are pieces of compliance, one of them being the sole benefit test. If you set up a self-managed super fund, you don't get to run this like you'd run any other trust or company that you've set up. You must set that thing and run that thing with the sole purpose of saving for your retirement. You can't make or get any other sort of benefit from it. So for example, you couldn't put your own house into your SMSF. You can't do that and then live in it. That's not saving solely for the benefit, for the purpose of saving for your retirement. So it's a lot of extra compliance in it, and ultimately over the long term, I'm not sure. Claire, who are you with Superwise, or Stacey, or Risby? Risby, have you got super set up? You should probably have a super provider, I imagine, if you've derived a bit of money here and there from Australia. You haven't got that, you probably will. Sun Super, okay. What I do recommend when you go and set that up, go and get what's called an industry super fund, and I think I've got them on the next. Next slide. Maybe on the next slide. Oh no, I haven't got the. So I have UniSuper, which used to be you had to work for a university. Now they've opened it to members of the public. You should definitely do that. Why? Because they just outperform other super funds. And look, when I first arrived here, I had no idea how this worked. And so the recruitment agent literally did the equivalent. I don't know if I haven't got the recording, but did this thing with his hands. You know, you can see his eyes light up. Why? Because they get kickbacks if they put you into certain schemes and sign you up for certain products. So that guy cost me a little bit shy of $10,000 because they ended up signing me up to all of these things with all this insurance, which I never ever used, didn't want, tried to get out of it, couldn't, and eventually what was left over just got transferred to my UniSuper account. As I said, it cost me, between $6,000 and $9,000 Australian dollars, which I was really quite grumpy about, but I didn't know anything, didn't know any better. Okay, so super. When you're talking about superannuation, you need to know the three phases. The one is when things, I can draw a little diagram. If we think of our super, it's going in, it's then earning, oops, that's an arrow, and then coming out. So you've got the Contribution phase, where money goes in to the super fund. You've got the investment phase, that's when money is earned by the super fund, and distribution phase, where money comes out of the super fund. Okay, that's what it is. Usually when you retire. So when you're contributing, there are some benefits to doing this. Okay, the first thing to note is that superannuation has what's called the superannuation guarantee. That is where your employer must contribute a percentage of your wage equivalent into your super fund. And it is currently, it's 9.5, but it's going up to 10%, and it's going to carry on to go all the way to 12% in 2026. Okay, so and look, you can have in your contract that your employer pays more than that. That's fine. They can do that if they want to, but they're not obliged to. With this, they are obliged to do that. And they pay this to you, and they pay it, that is in the form of, it's deemed to be non-assessable, non-exempt income in your hands. It goes into your superannuation account. Okay, JC pays a lot higher, so but yeah, not to casuals that don't. Yeah. Oh, JCU, me and HR. I'll put this on record. If HR go through and check this, no, I won't. No, don't speak your mind. So, the superannuation guarantee goes towards your nominated super account, okay, with your provider, and your employers must do that, but they don't have to pay for every dollar that you're paid beyond, and it's an indexed amount. It's about $240,000. In fact, oh, have I got it here? Low rate cap amount? No, I haven't got it here. No, I haven't got it here. All right. Notice where I've got these approximates. That's because these things have changed. And literally, this piece of paper in my hand has got the changes for this year. They index it, and it changes every year. So if you've got an employee that earns over about 250 grand in the end, you only have to pay up to that amount. Now, you can have in your contract or the award or the NES or whatever have you, the enterprise agreement or the award or the individual contract, you can have something where they can pay more, but they can't pay less. Okay. And if you are a low income earner, so you earn less than sort of 60 grand, the federal government will make a co-contribution of $500, up to $500 per annum into your super as well. All right, let's go. That's the contribution phase. And this slide, again, it's like FBT. Some fraction of you, this is going to take up a lot of your time because the first $27,500, and I'll just check, I think that hasn't changed. Concessional contribution, no, $27,500, all right, is a tax deduction, sort of. In that you can, leaving aside the money that you're reducing, the amount of money your employer pays. So let's say, for example, I'm earning, $100,000. Stacey, you're paying me $100,000 per annum, right? That's my base salary. And now that the rate's 10, so 10%, so $10,000 of that, you're going to pay, not out of that, it's extra. So technically I'm earning 111, but 10,000 of that is non-assessable, non-exempt income. You have to pay $10,000 to UniSuper on my behalf. Okay, this is a good example. Okay, yeah, I like this. I like this because now that the numbers are nice and round, I like that. Let's put this down here. So I'm going, Stacey, thanks, Stacey. You are going to be paying me all of this money in yellow. Let's go. So it's 100K. What does that mean? It means that 10K is super. The SG payment, super guarantee payment. So you are paying that. So this this $10,000 is going away up here, and that's going to go to my nominated super account. So we'll say it's UniSuper. All right, that goes to them. All right, good. So that goes away there. Now, what I could also do is contribute in this particular tax year an amount out of my own pocket. And that amount is going to be $17,500. That's the maximum I can do without having extra penalties. 17,500 by me. I'll just put by me. Me. You guys can see that all right. What does that mean? It means that I get a tax deduction in regards to that. So I'm only going to be paying tax on whatever it is, $82,500. Now, technically, it's not done as a deduction. Technically, it's done as an offset that equals the amount of deduction you would have got, because trust them to make it complex. But basically, I'm putting my money into super. I'm essentially doing that ahead of tax. And if you're advising clients to do this, always tell them to do this. If you've got spare cash, put it in your super. Why? Because it's you giving money to you. It's still your money when it's in super. Yeah, the one thing you can't do is grab it right now, but you get it at some stage later. Or if you die, your kids get it or whoever. But we'll come back to that. All right, so that is called the concessional contribution cap. It's $27,500. Very important rule though, you must do that before the end of the financial year, which is really annoying for people like me that have no idea how much they earn. So you've got to basically have a stab at the dark in terms of what you're going through and getting paid. Okay, that's the concessional contribution cap. Now, these days, you can actually roll it forward up to 5 years. So you can move this, if you don't use it all, onto the next year. So you might have one big year, be able to go through and do that. And you can also talk to your employer and say, can you please do this as a salary sacrifice? My employer, again, because I'm casual, they won't do that. Thanks again. JCOHR, if you're listening, thanks. Okay, now note that this is a good way to save and put money into your super, but you can't do it if you've already got more than $1.7 million. The Turnbull government put that in place because people were using this to get the tax benefits. If you know how money works, you want to be using super. And knowing these rules, for you guys to learn it now, super, super handy. Oh my God, I wish this was explained to me in the same way I'm explaining now. Now, there's another thing though called the non-concessional contribution cap. Okay, so you can put money in this. You don't get a tax deduction though. All right, you're paying from post-tax dollars, the money that you've earned or whatever have you, and you've already paid tax on. And you can put this into your super, and it doesn't, well, it isn't taxed when it goes in, this non-concessional amount, whereas the concessional amount, the one you've got the tax deduction, this up to $27,500, when that goes into your super fund, it is actually clipped on the way in. It's actually taxed as it goes on, usually a small amount, 15%. If you're above the threshold, it's more, but it's clipped as it goes in, whereas this amount that you can put of up to $110,000 is not taxed when that goes in. So you can just literally move money from you to you and not pay tax on it. Why would you do that? Well, we'll get to that. We'll get to that. So you just need to know the difference between those two terms, the concessional and the non-concessional cap. Look, for the questions, when I'm putting these into questions, I'll assume these are going to be the two numbers we're going to use for the questions in the quiz. All right, so if you put money in that's beyond those caps, and look, sometimes this can be just by accident. Me, for example, because I don't know, I get paid, pay Charles, I usually do my pay twice a year, and so that I do my pay in late June. So I usually don't know how much I've got, and then often I miss the 30th of June to put money into my super because I'm disorganized. But note that you can't do it retrospectively. Okay, you can't decide after you've done your taxes, oh wow, I wish that I'd put that money in, let's move it in there now. They don't let you. So that's something to know in terms of when you're advising people. You have to do it in advance and plan things in advance. All right, so why would you want to put money in super? Well, what's the company tax rate? Drum roll, please, for small businesses these days. What's the company tax rate? Everyone's gone super quiet. I don't know. Oh no. Well, we did talk about it a few weeks ago. We were talking about income tax stuff. So it's 20 at the moment. I think it's 27.5 cents the dollar, 25. Maybe it's 25. And for base rate entities, yeah, 25. I think it's 25. It was transitional, and it's higher for larger entities. So either those with passive income streams of more than 80%, or I think turnover 50 mil. We've got a slide in it early on, but basically it's more than 15 anyway. And what's the top marginal tax rate? So if you're holding investments yourself and they're earning income, like paying you interest, for example, if you've got a bank deposit and you earn $10,000 worth of interest, but you already earn in your PAYE job 250 grand a year, what's the marginal tax rate you're paying on that? 47 cents to the dollar. So once you've put money into super, it's taxed at that. It's taxed at 15. And capital gains, remember we had this discount percentage of 33. So if you've got a capital gain on an asset that's held for more than 12 months, it's functionally only taxed at 10% because there's got a 33% discount percentage. If it's not subject to discounting, when we did capital gains a couple of weeks ago, then it's taxed at 15. It's just like it's income. If you buy an asset, if your super fund buys a capital asset and then sells it, so buys a packet of shares, sells it 6 months later, that gain is just going to be taxed as if it was income. But the income, the tax rate on super funds is only 15%. That's the huge benefit to this. It's a low tax mechanism. So you're not paying tax on stuff that is in there. Okay, that's the main takeaway from this. When money comes out, though, the distribution phase can only come out in a handful of ways. One is that you reach what's called the preservation age. Now, I've simplified this. Super is way, way complex to start with, because the preservation age and the retirement age were actually two different things. But the preservation age has been going up, and by I think it's next tax year, they're the same. They're going to be 60. So I'm just leaving that at 60. Just assume it's 60. Otherwise, it just gets really complex. So assuming that you have both reached the age of 60 and retired, you can then get money out of super. Okay, first thing. Or if you're permanently incapacitated, you can ask the ATO, demonstrate that you're permanently incapacitated, and get money out of super. If you suffer severe financial hardship, and look, I have to point out, it is severe financial hardship. The ATO are super, 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 super reluctant to let people do this, other than during COVID, where they're like, yeah, have $10,000. That was Parliament jumped in and let them do that. Or if you die, your super gets released, kind of obviously. Now, when they're looking at this, when they're doing this distributions, you have to look at amounts that were that had already been taxed in some way, either because it was taxed when it went in. So that, remember the concessional contribution amount of up to $27,500. That amount is clipped, taxed when it goes into the super fund. Okay, so that has already been taxed. If your super fund derives income, right, that gets taxed again at 15%. So those amounts, after you've put those amounts in, that capital, and after you've done those income, it's been they're taxed. All right, they've already been taxed. Whereas the amounts that you put in post-tax income of up to $110,000 per annum, all right, that amount is untaxed. Okay, and there's slightly different rules in regards to that, because it has to be clipped when it comes out. So when you are getting these distributions, if the amount's already been taxed and you're getting that money, it is tax-free. You're just getting your money. It's your money. You've already paid tax on it. Your super funds pay tax on it, one or the other. You're getting that money. It's your money. Here you go. Have your money. Okay. So those are the amounts that have already been taxed. For amounts that haven't been taxed, so the ones that you've moved, say you move 100 grand into your super every year under this non-concessional cap. Look, you don't pay tax when it goes in, but it earns, when it's earning money in your super account, it's only paying tax on the on 15 cents of the dollar. When it comes out, though, you've got to clip it at 15%, unless unless you're taking out more than $1.7 million. I know, difficult problem to have. In that situation, it's clipped at the top tax rate. So just make note, they want you to put money in super, but not too much. If you're putting more than $1.7 million into your super, you'd be advising your clients to do this in a slightly different way. Again, this is a relatively recent change, but it stopped people from putting, hundreds of millions of dollars into super. It ends a little bit silly. Okay, if you die, look, if you're paying your dependents, it does not matter whether it's taxed or untaxed, doesn't matter. If it's paid as a lump sum, wholly tax-free. Okay, if it's going to a dependent, that's your surviving spouse who's not earning, or your children. Okay, or if your spouse is either not earning or permanently disabled. Okay, and if you are paying to a non-dependent, okay, now you can pay lump sum to non-dependents, but that's taxed. And again, it's 15% for the taxable taxed component, 30% for the untaxed. All right, if you're paying a lump sum. If you pay a lump sum to dependents, wholly tax-free. You can't pay an annuity, so an income stream to a non-dependent. That's just not how that works. So if you die, you can't have your super fund set up in such a way to pay to non-dependents. Can be paid to dependent children, but only up to the age of 25. Okay, and then after that, it's got to come out as a lump sum for your children, or you can pay if your children have a permanent disability. You can pay, have that set up for the trustees to pay that as an annuity, as an income stream over a period of time. And again, that'll be, I think that's actually tax-free. Yeah, it's tax-free, but you have to set that up in such a way that in the deed that sets up your super. Okay, right, that's superannuation. Very, very last thing I'm going to talk about is a different thing called termination payments. And look, I had no idea about this. This is a very Australian phenomenon. So it goes like this. If you are paying an employee, right, you've got to pay them wages, sure. You pay their superannuation guarantee, sure. You pay them when they go on leave, they get annual leave, they get long service leave, you've got to pay those. And so when they leave, you've got to pay those amounts. But there is this additional amount, all right? It's an additional amount that you have to pay, known as the employment termination payment. And that employment termination payment is paid for these things, these specific items, usually that are set up in either the contract or the industry award or the enterprise agreement. Okay, it's a very Australian particular thing. So Rizvi, you may not know anything about this, and as a Kiwi, I knew nothing about any of this, because these ETPs do not include amounts that are outstanding for salary, wages, or any sort of allowance, any annual leave or long service leave, or anything to do with superannuation. Okay, those things don't form part of these ETPs. So the idea is that for all of this stuff, there are some tax benefits when you're going through and you're paid, but they're unrelated to the outstanding wages and things. The stuff that you're going to be paid anyway, that's still just income. You're just paying tax on it. The fact that you've quit your job or you've been terminated from your job for whatever reason, you've been made redundant, doesn't change the fact that's income for that point in time. It's just income. And we know this, that remember the compensation payments take the form, Mix's case, take the form of whatever they're compensating. So if you've been terminated and you've got a bunch of wages outstanding, it doesn't come part of this ETP. This is a special series of rules that you have for these particular payments that are listed here. So unused roster days off, sick leave, payment in lieu of notice, we've got wrongful dismissal, and redundancy payments. Okay, these are these particular payments that are set up in your contract. And if you are paying those to an employee when they leave, so if they're still alive, you have to look at what's called the invalidity segment. And that happens when an employee ceases to be employed, all right, and they have some form of ill health, all right? So if they're having to cease employment and it has, for whatever reason, some form of ill health is the reason, they're going to get some form of tax benefit from that. And basically what they do is they look at the length of time that you've been employed by that particular employment. So let's say Stacey's employed me for, I don't know, 15 years all up. And so you've got 10 years, sorry, start again. Let's say that Stacey's employed me for 15 years, all right? What we do to work out this invalidity segment is we look at the number of days to retirement, all right? And then we divide that into the sum of days employed plus days to retirement. So I won't do it in terms of years. I'll just do it. Won't days. I'll just do it in terms of years. But let's just say if I am, what am I now? Let's say functionally I'm 45. Well, actually I am because it's the end of the year, by the way. I think it's the end of the year. All right. You then go and look to see what the retirement day is going to be. And again, usually it's the 65th birthday. There are some professions that have a higher retirement age. Judges, for example, High Court judges retire at 70. And so this invalidity segment is that you take the number of days to retirement. So let's say for me, again, we'll do this in years instead of days. Let's say what's my 45, 65. So I've got 20, and divided that by the sum of days employed plus the days to retirement. So it'll be 15 plus 20. And whatever that fraction is, that is the invalidity segment of the ETP amount. So if say Stacey's got to pay me their ETP is say $10,000, some fraction of that, this amount, is going to be tax-free. That's the invalidity segment. Look, I don't know why they come up with this number, but the idea is that the further away you are from retirement, the bigger your amount's going to be, I guess, as part of that. The bigger the fraction of this is going to be paid. So if you were 1 year from retirement, this number ends up being smaller, I think. Yeah, as part of that. Okay. The rest of the amount, so once you've got the invalidity segment, that's going to be tax-free. The rest of it is taxed either at 15% if you're over 60, again at the end of the year, or 30% otherwise. Okay, that's that amount of that ETP. But that's also capped, and this has changed, by the way. This has changed in literally yesterday. The ETP cap for life benefit termination payments and death benefits. This is now, it's actually 230, which has gone up quite a bit. If it's beyond that, it's taxed at this 47 cents to the dollar. All right, that's going to be clear as mud at this stage. Just note there is a formula. You will get a question. It's going to involve the length of time where employee is sick and how long they've got till they retire. Okay. If you die and an amount is paid to a third party, we have to use this death benefit there. And look, ultimately, it's actually still the same amount. So this invalidity segment, even though the number of days to retirement seems a little pointless if you die, but this invalidity segment is still calculated the exact same way. But when it's paid to a dependent, the rest of it, this taxable component, is going to be tax-free. So ultimately, it doesn't really matter when you're paying a dependent because the taxable component is going to be tax-free anyway, up to this cap. All right, and so that's going to be paid to dependent, amount beyond that. However, it's 30 cents when paid to a non-dependent beneficiary. It's going to be at 30% as part and parcel of that. Okay, that's if you're paying it after you die. Finally, the very last thing I just want to talk about is this redundancy. When there is a genuine redundancy, I didn't use the word there, but it should have the word a genuine redundancy, or the employer has an approved early retirement scheme, then some amount of that they are paid as part of this redundancy is tax-free. Okay, and that amount is this amount here. So it's indexed, but it's currently about $12,000. In fact, I can tell you, it's currently, in fact, it is $11,591. And this annual service amount. So say, for example, I've been working for Stacey for 15 years, and it is full years. So it'll be 15 times 6 plus 12. So whatever it is, 15, 6, come on, brain. 30 plus 6, and this is 90. So that would be $102,000 would be tax-free. Yeah, up to that. Note, just one thing to note here, only complete lots of 365 days count. So if I had worked for 14 years, 363 days, you'd only multiply this by 14. That's just how that works. And that amount will be tax-free. As a genuine redundancy or early retirement amount.